After a manic spell, it's thankfully going to be a bit quieter in the week ahead, although it should be no less interesting. The main macroeconomic items of the week will be the monthly UK inflation figures on Tuesday the 14th, followed immediately by the latest unemployment and wage growth numbers on Wednesday. These inflation figures are particularly important as the Retail Price Index, or RPI number, is used to set the next annual increase in rail season tickets and a few other items. A year ago, RPI inflation was 3.6%, and it was still 3.3% in May, so brace yourselves. As for the other headline numbers, the Consumer Price Index, or CPI, measure of inflation, was 2.4% year on year, and the Bank of England's preferred CPIH measure, which includes owner-occupier housing costs, was 2.3%. Remember that the bank's mandate is to keep inflation around 2%. Governor Mark Carney will also be watching the wage growth numbers, as any acceleration here could trigger more interest rate increases, even if Brexit seems to be a bigger worry for Britain's central bank rather than bumper pay rises. Last time around, UK unemployment was unchanged at 4.2%, and wage growth, including bonuses, cooled to 2.5% year on year. That left real wage growth of 0.1% a year once you take off inflation. Big deal, you might say, and I'm sure lots of retailers and travel and leisure companies would like to see that number rise, as it will put some extra spending power in consumers' wallets. On the corporate front, just 3 FTSE 100 firms are set to release results or provide a trading statement, although a few FTSE 250 companies will get in on the act. Names to note include shipbroker Clarkson on Monday the 13th of August, copper miner Antofagasta on the 14th, insurer Admiral, Balfour Beatty and property play CLS Holdings on Wednesday the 15th, gambling company Rank and another copper miner, the controversial Kazakhstan-based Kaz Minerals, on the 16th. But the company most likely to cause a fuss in the week ahead will be DIY retailer Kingfisher, which is set to release a second quarter trading update on Thursday the 16th of August. The company owns B&Q and Screwfix here in the UK and Castorama in France, as well as operating in 10 countries across Europe. As we can see here, the shares are down. A lot of the blame for that rests with the disappointing full-year results in March, which hammered the shares lower. Investors were underwhelmed as Chief Executive Veronique Lowry unveiled weak UK sales growth, disappointing cash flow, and admitted to ongoing product availability problems as her executives sought to implement the One Kingfisher turnaround plan. May's first quarter update was not much more inspiring, so this update is an important one as it represents the halfway stage of the 5-year One Kingfisher programme. That means it's a chance for management to persuade investors that everything's coming together rather than coming unglued. The first half figures will be released on 19th of September, but in this statement, analysts will be focusing on the like-for-like sales growth. In an attempt to be helpful, the company reports 3 sales growth figures: total sales in constant currencies, and like-for-like sales in constant currencies. Analysts will home in on the like-for-likes. In the first quarter, the outcome was a year-on-year drop of 4%, a weak result, although management put the blame for that on the beast from the east and the spring freeze. Attention will then switch to the regional trends that lie beneath those headline figures. In the first quarter, the UK and Ireland was down 5.4%, France was down 3.9%, and the rest were up 0.9% on a like-for-like constant currency basis. I think it's fair to say that investors will be looking for marked improvement on all fronts. Finally, keep an eye out for the commentary on One Kingfisher, especially with regard to margins, cost and product availability, as well as share buybacks. Remember that the plan has 2 key thrusts. First, to generate a £500 million profit uplift over 5 years through higher operational efficiency across the brands, cutting costs and improving its digital offering. Second, an additional £600 million in capital returns above its regular dividend payments over the next 3 years. Thank you for watching, and I look forward to seeing you again soon.